Hello, everyone. Today's article in the Orange County Register is really broaching the question, is today's housing market similar to 2008? So we're going to kind of go over that article. There's several other articles out there, a little bit of doom and gloom. That's kind of clouds that are coming in. And I want to go over what I really feel that the housing market is in at the moment, as well as we have interest rates that we want to go over. All that in Real Estate Daily. Welcome, everyone. My name is Troy, and Monday through Friday, actually Monday through Saturday, we go over the latest news in real estate, housing, and the mortgage markets. Now, before we jump into this, please let's go hit that subscribe button and turn on your notifications so you'll get notified every day, the 5-10 minute video that I'm going to put out every single day to give you the latest news in real estate and mortgage. Boom. Do that for me. Now let's jump into it. Orange County Register, it says, if icy housing market isn't a 2008 replay, then what is it? Now, it says California prices dipped 80% of the time, even when 2007 to 2012 crash is excluded. Now, we understand that, everything can't go up, forever, but you really got to look at some of the reasons why the market, and you're seeing all these crazy graph going on. Why is there such fluctuation across the United States and in here in Southern California? I think the number one issue here is loans and how lenders are looking at loans. I know that, in the past, when money was really cheap, they would do loans, they would do liar loans, they called them. They're neg-am loans. There's just so many different names for them. It's taken some of the banking system down. It took hedge funds down. It's taken a lot over in 2008 especially. But what is really significantly different than 2008 to today? Well, in 2008, we did see 6, 7, and 8, we did see home prices go up. But when the market stalled because of the loans, people were unable to pay their loans back. They were always being promised that you can refi next year and you'll have equity. You can refi next year and have equity. You can refi next year, but lenders, as well as buyers and people who refi, they always took the cheapest way out. So if you were given 4 or 5 options to either pay a 30-year fixed or an option of paying, 2% or 1% of, and you're just paying the interest of that and paying no principal because you're going to refi next year anyways, right? Then people always took those options. And when the housing market stopped and they couldn't refi their homes, that's the crisis of 2007, 2008. So the liar loans that came in, the bad decisions, when they call liar loans, part of it, I think it's the mortgage industry was liar mortgages more than anything else. So with that being said, I think that's a significant difference than today. The majority of buyers today that had over the last, especially 72 months, is people who have money, and now they have a significant amount of equity. So they put money down on their house, and then we saw the housing market really, take off, and now they have equity. A lot of people have equity, 50% or more equity. What scares me though is all the lenders who, once the refi boom went away, what was the next thing they were pushing? They were pushing, cash out refis. That's not good. And cash out refis, especially in the last 12 months, have been detrimental to most people. Meaning, yeah, if I needed the money and if it was for emergency, it made sense. But if I'm just pulling money out to pull money out, and my interest rate goes up, so my balance goes up, my interest rates go up, and on a lot of these, it reset my loan. So my loan went back from, if I had paid 2 years down, now I'm back to 30 years. So I went from a 28 years left of my loan, now 30 years again. So I'm paying 2 more years of interest pretty much. And with that being said, it just, these are things that concern me about this market. And then the things that I don't feel that are 2008, absolutely, we're just seeing so many people that have put money down. They don't feel like they're a glorified renter, and we haven't felt that pain yet. Now, going forward, we're gonna see what's happened. I've seen a lot of predictions that, and Orange County Register being one of them, that we're going to start seeing the amount of equity go down. In fact, it will be negative. So year over year negative. Right now we're not year over year negative. We're up from last year, but that is their prediction, is sometime in the first quarter or second quarter of 2023, we're going to see year over year negative, a negative equity position in homes. That's not terribly bad, to be very frank with you. But on the other hand, we want to make sure that housing market stays strong enough. We don't need a replay of 2008, because if we do, guys, you're not buying homes. Hedge funds are buying your homes. And the hedge funds are to hold on to them. And when they hold on to houses, that means you become a renter. They put more of society as renters. And as a renter, you have no control over a monthly payment or a monthly rental payment or a lease payment. It's going to change every year. They're going to keep raising. So, next article. Here's why some homeowners skipped the refinance boom and don't regret it. This is Yahoo News. So there's a few reasons in here. I think the number one reason is if you have gone into a loan 5, 6, 7 years already and you wanted to refi, well, your refi is typically 30 years. So of a 30-year loan, you had 23 years left. If you refied it and your rate went down and you had a lower payment, well, you had to recast that entire loan. You were back to 30-year loans. I think a lot of people out there, again, it's, I really feel that the mortgage industry I needs a lot more education and needs to educate a lot more people out there. I know that, some of my partners, including What's a Mortgage, Min Win, he's very good at it. But if you've gone 7, 8 years into a loan and you paid it, any refi that's going to be on my desk would be a 15-year refi. And that 15-year refi at a lower mortgage rate would probably be about the same payment, but I just trimmed off another 7 years of my loan. So instead of having, increasing the amount of years on my loan to get a lower payment, I've now kept my same payment and I reduced from 23 years down to 15. And with a 15-year loan, I'm paying so much more principal than I would on a 30-year loan, which I'm not really paying. And guys, I told you this now for about 6 months, 40-year loans are here. And in Japan, they have 100-year loans. They're going to come in with longer term loans. And if that's a fact, and they come in with a lower interest rate, when people can afford it, it can cause another housing boom. And I think that's what the reality is going to be. I think there's going to be somewhat of a housing boom in the future, in the next 3 or 4 or 5 years, because the financing of loans are going to get extended and it's going to push things up. Also, I think that a divided equity or a dual equity position for loans where banks will come in and you will pay, you'll own 50% of the house you live in, and the bank will own 50%, and they'll loan you, they'll have a loan for 50%. So you'll have dual equity or shared equity into that property. I think that's a product that's coming out. It's going to be tokenization of real estate, and that is a true and real coming event that's going to happen before 2030. Next, housing consumer sentiment very cautious, says Tri Pointe Homes CEO. Now, Tri Pointe Homes is a new home builder, so they have a different mindset than the majority of you out there. Majority of people out there absolutely have, they have a resale home. They didn't buy a new build. So he's saying that it's cautious. I say it's very cautious at this moment. We'll see here in a minute as interest rates continue to rise that we can see if we can, pull this off and bring those interest rates down. It's going to be a very, very interesting month with the Fed and the CPI numbers. How's the Fed going to react? Is CPI going to go up, slightly down? Is the Fed going to react like, oh, the jobs markets are still strong and we're still seeing a significant and over 8% inflation? Am I going to continue to tighten? And I think that if they do a big tightening, I don't think interest rates they're built in at this point. I think we're going to see a 6.5 interest rate before the year's up, or actually by November, we'll see 6.5. And that's where you start getting the 40-year, or I call it the exotic, crazy loans, like the 40-year loan, maybe a 50-year loan, where they're just bringing that payment down so you can afford it and you don't have to pay these crazy rents. You can afford it, yet they're going to suck out so much more of your money. I even call it, I've said this once or twice to Emmy, call it generational loan, right? You pass that bitch on to your kids, right? After 50 years. I don't know how many of you are going to live in a house in 50 years, but you absolutely do that. So just food for thought. And if you sell your home, I'm partly telling you that we're going to have hedge funds continue buying the market. They're going to buy in this market, and they're going to make more and more of your kids renters. And that is absolutely, I feel, the government's way of doing things right now. They're not looking into home ownership. They're absolutely looking at rentals, and having big corporations come in and buy, tens of thousands of homes. Next article. All right, this is interest rates. Not good at all. 30-year conforming conventional went up 10 basis points yesterday. It's literally sitting at 6% on that cusp. We're looking at FHA up 9 basis points at 5.765. I've been saying this for a while now. Jumbo has just been on the most volatile, I've ever seen it. I mean, you're talking up, down, and these huge swings. You're talking it's now down 18 basis points today. That's kind of crazy, or yesterday I should say. That's crazy. It's going all over the place. I remember, at one point it had never even crossed that 5% in years and years. It crossed it, went up to 5.5, touched it, went all the way back under 5. And now it's just like, again, the roller coaster is here. It's just flying up and down, up and down, up and down. So very, very interesting to see that happen. I think that a lot's going to happen. The CPI numbers is coming out next week. The Fed's meeting at the end of the month. And this is kind of the last time that they're going to raise, with numbers in hand before the elections. And I think we're at the election. I think they're just going to go, and there's going to be some crazy things happening. But that's for another video, another time. So, well, guys, thank you very much for joining me. I definitely appreciate it. If you like the video, hit the like button. Otherwise, comment below. I have no problem, listening to your ideas and thoughts, whether it be, for, or, you have a different opinion than me. I'm more than happy to read them and, possibly just answer them as well. Other than that, you guys take care, and I will see you tomorrow.